Okay, thank you everyone for joining me today for the Forex Education Hour. I'm James Harte from Littlefish FX, and in today's session, we're going to take a deeper look at something which we touched on in the last session, and that is the use of technical indicators, specifically the stochastics and MACD indicators. So for those of you who didn't catch the last session, you should go and check that out. We were looking at why you should conduct multi-time frame analysis, the benefits that it will have for your trading, and the different methods you can use for conducting this analysis. And within that, we were looking at using these stochastics and MACD indicators. So in today's session, I want to take a look at these two indicators in isolation and talk about some of the great ways that you can use these indicators in your own trading. So as ever, if you have any questions throughout, please just write in the chat function and I'll stop periodically to answer. So first of all, what is the stochastics indicator? The stochastics indicator is a momentum indicator which has a structural reference, and it's looking at the most recent close compared to the high and low over a certain period. So the indicator measures momentum in the market, and it also signals momentum as being overbought or oversold. So the indicator setup is that we have a lower and upper limit giving us the overbought and oversold conditions set to 80 and 20. And there's quite a lot of discussion around which settings you should use. You'll note that the default settings on NinjaTrader are a 3, 3, and 5 period. And on some other platforms, they're slightly different. But the bottom line is that for the most part, where the settings are pretty similar, the settings themselves aren't hugely important. So what is more important is that you're able to develop a solid way of trading the indicator. So in that respect, I suggest that you actually spend some time looking at the different indicator settings to find settings that you like. Now, obviously, where the settings are vastly different, then you need to consider that the lower your settings are, the more sensitive they will be to price, because you're looking at a more recent range. And the higher your settings are, the less sensitive the readings will be to price, because you're looking over a much longer range. So here on this panel, we have our regular 335 stochastic, and you can see that it's fairly sensitive to price. We're getting quite a lot of rotation, whereas the indicator set up below, which has much higher inputs of 20, 20, and 40, is actually far less sensitive to price, and you can see how infrequent the oscillations are between the upper and lower limit. So that's the bottom line to the indicator. It's measuring momentum in the market by looking at recent closes relative to a high-low range over a certain period, and it's signaling momentum as being either overbought or oversold or somewhere in between. Now, in terms of how we can use the indicator, as with most momentum indicators, when it comes to trading them, the methods that we can use fall into two broad categories. So first of all, we can use the indicator to look to fade price action as the indicator signals momentum exhaustion. And then the second is using the indicator to highlight divergence, again looking for potential reversals. So let's look at some examples and discuss these methods. So in this example, we have sterling CAD on a 4-hour chart, and you can see here there are several areas highlighted where the stochastics moved into extreme territory, and look how prices reacted each of these times. So initially, after this steep decline, we bottomed out as the stochastics registered an oversold readings. We then corrected higher, and the correction was capped as the stochastics registered overbought readings. Okay, so this is downside exhaustion and this is upside exhaustion. So when the stochastics move into overbought territory, it's likely, or we do sometimes see, a correction lower. And again, when the stochastics register oversold readings, we can see a correction higher. And look at the amount of times that the stochastics moved into extreme territory during this period and caught reversals. You can see that we had several reversals here from this resistance area lower as the stochastics registered overbought readings. Again, once we made our ways into the highs of the period, you can see that we got a double top here with the stochastics registering an overbought reading, and again we sold off lower. We chopped around in this range before making a sharp break lower, and as we did so, the stochastics registered oversold momentum, and you can see that we actually corrected higher once again. So that's roughly a 6-week period or so in quite a volatile pair, and you can see that it was a particularly choppy period, but look how well the stochastics could have helped you navigate this market. So simply waiting for the stochastics to move into extreme territories before taking any sort of directional bias can be a really great way to help you in your trading. And this is the first and the most simple way in which you can look to use the stochastics indicator. Simply looking to fade price as stochastics move into extreme territory, signaling a potential reversal in momentum. So this is quite similar really to how we would use an indicator such as the relative strength index, whereby we look for the indicators move into extreme territory. But with the stochastics indicator, we actually have some additional functionality that can improve our trading and improve our entries. You'll notice that the indicator has 2 lines running instead of 1. So these 2 lines, we have the D line, which is the green line and the slower stochastic. And then we have the K line, which is the yellow line and the faster stochastic. So essentially, with the information that these 2 lines are giving us, what we want to see happen, for example, to give us a short entry, when price is overbought, as it is here, we want to see both lines move up above the upper threshold, above the 80 limit, which signals overbought momentum. And then we want to see the K line, which again is the yellow line here, cross below the green line to give us our short signal. So looking at this example here, okay, you can see that both lines run up and touch the overbought threshold at this point. However, we don't get short at this point. We wait for the K line to cross below the D line. We wait for the yellow line to cross below the D line. And so we can see that price actually runs on by another few candles. And then we get the crossover at this point here and we get our short entry. So this is why this indicator can be a lot more useful than an indicator such as the RSI, because this additional information can create for more precise entries. So again, if we were simply looking to short just as price moved into overbought territory, we actually would have suffered a little bit of drawdown here as these candles continue to push higher. But waiting for an actual crossover of the stochastics lines, of the K line and the D line, you can see that we actually catch the exhaustion rather, quite nicely there. So is that clear to everyone? These are the basic ways that we're looking to use the stochastics indicator. Are there any questions at this point? Okay, so that's the basic way that we can use the stochastics indicator, looking to capture periods of potential exhaustion in the market where price is likely to reverse direction. And the indicator can actually be really useful, not only in timing our entries, but also in guiding our bias in the markets in general for conducting our basic analysis. For instance, if we establish that overbought readings are likely to precede a reversal lower in price, then we don't want to be looking to buy if price is overbought or close to overbought. And similarly, if oversold readings tend to see a correction higher, then we don't want to be trying to buy into these oversold readings. We don't want to be trying to sell rather into these oversold readings. So stochastics can be a really great tool to use as a filter for timing your trades. And in fact, a really great way to use stochastics in this capacity is to use stochastics in your multi-time frame analysis. Now, as I say, we looked at this in our last session, but for those of you who haven't seen it, I'll just show you an example and we'll actually look a little bit deeper at how we can use stochastics to identify directional bias on the higher time frames, and then look to use the stochastics on the lower time frames to actually pick precise entry points. So on this Australian dollar daily chart, we can see that over the October to November period, we had stochastics flagging overbought momentum in the market. And then you can actually see that momentum, after it exhausted to the top side, started to move lower. So knowing that the stochastics on the daily time frame are coming off overbought territories and are likely to see a reversal lower, what we then want to do is look to the lower time frame stochastics to find periods of overbought momentum on retracements higher to allow us to try and enter in line with the dominant trend. So this is the same period that we just saw on the daily chart, but we're actually zoomed in here on the 2-hour chart. And you can see that as price is selling off from that higher time frame overbought momentum reading, we actually get quite a few retracements higher that come just shy of tagging the overbought level. So we don't actually get an opportunity to short just yet, but you can see that price continues to trade lower. And then at this point here, you can see that we correct higher, we get a little spike in price, and the lower time frame stochastics register momentum as being overbought. So at this juncture here, we know that the higher time frame stochastics are correcting lower from overbought momentum in the market. So our directional bias is to look for downside. And then on the shorter term, on the lower time frame stochastics, we found a period of overbought momentum to the upside. So we look to play this exhaustion to trade an anticipated reversal lower in line with the dominant higher time frame trend. And you can see that we actually get quite a nice sell-off here. And if you're waiting to exit until the indicator registers oversold, then you actually got this breakthrough support here and caught quite a nice move. So this is a really great way to look to use the stochastics indicators, to use multi-time frame analysis to highlight dominant momentum on the higher time frames and then drop down onto the lower time frames to find more specific entry points. And the great thing is that this method is perfectly scalable. So we've looked here at how you can use the daily stochastics to signal directional bias. And then we've looked on the 2-hour charts to execute. But you could do the same thing with the 2-hour charts and the 15-minute charts, or the 4-hour charts and the weekly charts. It's the same premise. Now, one thing to point out here is that stochastics, like all oscillators, tend to work very well in choppy and range-bound conditions where price is rotating a lot, but they can actually suffer quite a lot in trending conditions. So you really need to keep an eye on market conditions, and where price starts to trend, don't get caught out continually trying to play the market from the same side, okay? You need to use knowledge of support and resistance and basic market structure to assess what state the market is in. And this will help you to avoid taking unnecessary losses with using this indicator. Because as we looked at, if you're just trying to use the indicator in the basic way to fade potential periods of exhausted momentum, well, if the market is trending higher, generally we'll see the stochastics keep flagging overbought levels quite a lot, but price continues to push higher. So really, where we can assess that price is moving heavily in one direction and we're getting continual readings on one side of the stochastics indicator, then one very simple filter you can put in is to say, for example, that you won't take any more than 2 trades from one side of the stochastics indicator. So a simple adjustment like that can help you to protect yourself from taking unnecessary losses. Now, another way that we can use the stochastic indicator is to trade divergence. And this is where we start to get a bit more strategic with our indicator use. So divergence is where we identify moves in price which aren't supported by the indicator, and where the indicator is signaling to us that moves we're seeing in price are vulnerable to a reversal. So in this chart here, and we have a great example of what I'm talking about, you can see that price is moving in a nice uptrend. We're making a series of higher highs and higher lows, and we're pushing higher And then at this point here, we start to top out and correct lower, and we start to trade in a bearish channel, which for those of you familiar with chart patterns, we call it a bull flag, where we see a bearish channel forming during a correction in an uptrend. And that's another subject that we'll touch on in a different session, chart patterns. So we see this correction lower during our uptrend, and we can see that price is trading in a neat bear channel. Now look at what the stochastics are doing as price is trading within this channel. So the stochastics are the price is moving lower within this channel, and you can see that stochastics are also moving lower. We're making a series of lower lows as price pushes down within this channel until we reach this point here where momentum actually starts to reverse. And although price is continuing to push lower, the stochastics actually start to push higher, making a series of higher lows rather, and higher highs. So when we see this type of situation occurring, this alerts us to the fact that momentum is actually starting to build in the other direction, and price is vulnerable to a reversal, in this instance higher. So where we're looking at price correcting lower within an uptrend, and then we identify bearish momentum waning as price continues to push lower, then that signals to us that a reversal is likely to happen. So again, in terms of looking to trade with the trend, which for as much as possible is how we want to be trading, this is a great way to find entries. Okay, so looking for a correction within a trend and then looking to identify stochastic divergence to alert you to a possible trend resumption entry is a really great way that you can look to pick off entries in. Is everyone clear on that? Are there any questions I can answer? Okay, great. Well, if there are any questions at any point, please just write them in the chat function and I'll stop to answer them. Okay, another thing to point out here is that you'll also notice, I'm not sure if you'll have seen actually, but in this slide, I'm using slightly different stochastic settings. I'm using 3, 3, and 8 instead of 3, 3, and 5. And again, this just comes down to personal preference. Often actually on MT4, I use 12, 3, and 3. I find that that works really well. The setup on NinjaTrader is a little different, and so I use 3, 3, 8 for the majority of the time. But again, play around with the settings and find the ones that work best for you. So going back to divergence then, another way that we can use this to create trading opportunities is to look to identify divergence at key structural levels, so at big support and resistance levels. And this can be really great for catching a reversal. So we've got a question here. When you use bottoms and when you use tops, when do you use bottoms and when do you use tops when drawing trends in stochastics? So if the stochastics are moving higher, then I simply attach a rising line to map the movement of the stochastics. And if the stochastics are moving lower, as you can see they were here, then similarly you could have drawn in a declining line to map the movement of the stochastics. So what I'm looking for in an uptrend as price is pushing higher, I'm looking for price to correct lower within that trend. And then I'm looking for divergence in the stochastic. So as price continues to push lower in this short-term channel, once I note that the bearish momentum is waning and bullish momentum is starting to build because the stochastics are starting to push higher, then this alerts me to the fact that a potential reversal higher, in fact, a continuation of the dominant trend is likely to happen. Is that clear? Does that answer your question? So if price is pushing higher, you want to highlight bearish divergence, which is lower highs on the stochastics. And if price is pushing lower, you want to highlight bullish divergence, which is higher lows on the stochastics. So just always think of it as the stochastics starting to move in the opposite direction to price. So that will most clearly identify divergence for you. Okay, great. Okay, yeah, so going back to divergence, another way that we can look to identify divergence is key structural levels, identifying divergence at big support and resistance levels, because this can be a really great way to catch reversals. So in this example, we can see that as price is moving up into a key resistance area, so we have this really sharp impulsive move to the upside, we stall out and reverse lower, we trade back up and we retest that high. And you can see that as price pushes higher, and we actually just push past it, the stochastics indicator is actually registering a lower high. So instead of momentum increasing at this point to the upside, we can see that bullish momentum is actually waning. So price is pushing higher, the stochastics are actually making lower highs. And then you can see that as we push up this final time into this resistance level and again push on to make yet new highs, there is even clearer bearish divergence with the stochastics indicator making yet another lower high. So this again alerts us to the fact that momentum, bullish momentum, is waning here, and we're starting to see bearish divergence. So in the same way that we saw divergence happening as price traveled in a channel, alerting us to a reversal, well, we have the same dynamic at play here. Price is pushing higher, and yet the stochastics is starting to move lower. And so this alerts to us that bearish momentum is building, and you can see that we do indeed break lower from this level and trade down. And then look, we get the same thing happen same thing happen, but in the inverse situation. So this time we stall out and make a support level. Okay, we sell off sharply, we bounce from this level, and then as we trade back down and retest that support, you can see that the stochastics indicator is showing bullish divergence by making higher lows. So to the top side, we've had price pushing higher, but stochastics moving lower, and then to the downside, we've had price moving lower, but stochastics moving higher. And in each time, we've seen a reversal happen. So again, this won't always be the case, but where we can identify these situations, then there is a strong likelihood that we're going to see a reversal. So this can be another really great way to use the stochastics indicator to highlight divergence. So looking for divergence as price moves in clear channels, also looking for divergence as price tests key structural points. So looking at these different methods, from the basic way of using stochastics to identify periods of potential exhaustion to fade price, and then being more strategic and looking at stochastics to identify divergence in different scenarios, you should see that this is really an effective and very versatile indicator. And you can use it to get a gauge on market direction, but also to help you in the precise timing of your trade. So this is definitely an indicator that if you haven't already, you should spend some time looking at, because it really is a great one to use. So next we'll move on to looking at the MACD indicator. But again, are there any questions that I can answer for anyone before we move on? Okay, so the MACD indicator. The MACD indicator, the moving average convergence divergence indicator, is a momentum indicator, but it's also used to signal trend direction in the markets. So the indicator measures the difference between a short and a long-term moving average. So this is the MACD indicator. It comprises the MACD line itself, which is the green line here, and this is the 12-period moving average of price minus the 26-period moving average, and then a signal line, which is a 9. The signal line is the purple line here, and this is the 9-period moving average of the MACD itself. We then also have a histogram of the MACD, and what this is doing is it's charting the difference between the MACD line and the 9-period moving average. Okay, so there are quite a few things going on there, but the bottom line to remember with this indicator is that if the histogram is positive, the histogram is positive rather, when the MACD line is above the signal line. So when the green line is above the purple line in this instance, the MACD histogram is positive. And then when the MACD line, the green line, is below the purple line, the histogram is negative. Now, another thing to point out is that although this is a momentum indicator, it isn't an oscillator in the same sense that the stochastics is, because the indicator isn't actually bound. So you'll see we don't have an upper or lower limit here. So it isn't signaling overbought and oversold momentum so much as it's used for signaling the direction of price. Now, another important thing to note with this indicator is the crossing of the center line, the 0 line, by the MACD line itself. So again, the MACD here is the green line. So when the MACD is above the 0 line, then that indicates bullishness in the market. And when the MACD line is below the center line, that indicates bearishness in the market. Okay, so is everyone clear on that so far? I know there are quite a few things to look at there, but these are the very basic things to remember when using this indicator. Does it have different settings for different time frames? The settings, the default settings are 12, 26, and 9. I mean, obviously, if you're looking at different, you can see here we're looking at a daily chart. So the 12, 26, and 9 refers to daily periods. Obviously, then if you're down on the hourly chart, that would refer to hours. So again, as with the stochastics, and really as with all indicators, what I suggest is that you take a look at different indicator settings and play around with it a bit and find the settings that you feel most comfortable with. Again, the lower your settings go, the more sensitive they'll be to price. And the higher your settings go, the less sensitive they'll be to price. So it really is just about finding the settings that work best for you. But these are the default settings for the indicator, 12, 26, and 9. Okay, so that's the basic introduction to the indicator. So now we need to think about how we can actually trade using the MACD indicator. We've introduced actually the two basic ways that you can look to trade the MACD indicator in the introduction there. So we have trading a crossing of the signal line or a crossing of the center line. But the best way really that I find to trade the MACD is actually to combine these two elements. So not to use them in isolation, but to use them together. So let's take a look at an example and I'll explain. Okay, so we've already identified that the MACD line, again, the green line in this instance, crossing the signal line, which is the purple line. If it crosses it to the upside, it's a buy, and if it crosses it to the downside, it's a sell. And then when the MACD line is above the center line, so above the 0 line here, so when the MACD line is above it, as it is here, this indicates bullishness in the market. And then when the MACD line is below the 0 line, as it is here, this indicates bearishness in the market. So basically what we want to look to do is identify the MACD line as being either bullish or bearish, and then look for a confluent crossing of the signal line for an entry point. So in this example here, we can see that the MACD line is below the 0 line, okay? We drop down below here, we then come back up slightly, we come down, and then from this point on, the MACD line stays below the 0 line, indicating a bearish bias in the market, okay? Indicating to us that we should only be looking for selling opportunities. And you can see, looking at the price chart, the price is trending down quite nicely. And so at this point, what we then want to do is identify periods where the MACD line crosses below the signal line, giving us our short entries. And you can see here highlighted the various times that the MACD line has crossed below the signal line, okay, to give us our short entries. So we get a small retracement higher here. The MACD line goes above the signal line, crosses back down, giving us our short entry. We then sell off at this point here, continue lower. Again, we pop to the upside. The MACD line comes back above the signal line, but price turns lower once again. And as the green line, the MACD line, crosses below the signal line, we get another short entry. And then we get our final one over here, okay? So is everyone clear on that? So we're using the MACD line either over or under the zero line to give us our bullish or bearish bias, and then we're using the actual crossing of the MACD line and the signal line for our precise entry points. So in this instance, the MACD line is below the zero line, which gives us our bearish bias, so we're looking for short entries. And then we use these periods where the MACD line crosses below the zero line to give us our precise short entries. So it's quite simple when you look at it broken down in this manner, but it really is a very effective way to use the indicator and to combine the two elements. And again, as with the other trading methods that we've looked at so far in this session, this is a fantastic trend trading method that you can employ, and where price really starts to settle into trending phases, you can get some amazing entries. And as you've seen with this example here, generally you get quite a few entries per trending phase. So depending on how you manage your trades, there is a really good opportunity for compounding here. And the beauty is that if you do combine the functions of the MACD to trade like this, then generally you'll stay safe through a lot of the chop. Because with using the indicators, like with the stochastics indicator, how it can suffer a bit in trending markets, well, the MACD indicator, generally this can suffer a bit in ranging markets whereby it's chopping all over the place. So if you're just looking to focus on one element, either the MACD line as above zero or below it, or looking at crossings of the MACD line and the signal line, then in choppy markets, it can really start to suffer and you get a lot of false readings. But if you look to combine the two elements, so if you're looking for MACD line to be one side of the zero line to give you your direction or bias, and then you're using crossing of the MACD line and a signal line to give you your entry point, then generally you'll find that this will help you to stay safe or safer through the choppier range bound periods, because to actually get those two elements to line up, price has to sustain quite a decent directional move. So generally we won't get these two elements together and we'll just get one or the other, whereby using this strategy there is no signal for entry. So again, we only look to use the two elements in conjunction with one another. So is everyone clear on how we can use the MACD indicator in this respect? Okay, great. Okay, so we've looked at the stochastics indicators and we've looked at the MACD indicator and we've looked at them separately. Now, finally, for the last part of the webinar, we'll take a look at how you can combine these two great indicators together. So again, if you have any questions at all, please just write them in the chat function and I'll stop to answer them. So we know that stochastics are a great measure of momentum in the market. And we know that MACD indicator is a great indicator for trend direction in the market. And so essentially what we want to do is use the MACD indicator to indicate our trend direction, to give us our directional bias, and then to use the stochastics for entry points. So in a similar way to how we've combined the two elements of the MACD indicator here to give us our directional bias and then to give us our precise entry points, we can also do the same thing by combining the stochastics and MACD indicator together. So let's look at an example and I'll explain that. Okay, so in this example here, we can see that we have the MACD line is above the center line, which we know indicates a bullish trend bias in the market. So when the MACD line is above the center line, we want to be looking for buying opportunities for bullish setups. And then we can also see that the stochastics are registering oversold readings, which give us our long entries. Okay, so we looked earlier at how stochastics registering oversold momentum can typically precede a bullish reversal higher. So we're basically just combining these two elements. We're looking to the MACD to give us our directional bias in the market, and then we're looking to the stochastics for precise periods where we can enter. And so essentially what we're looking for is periods of exhausted downside momentum in the market in line with our broader bullish bias to give us our specific entry points. And you can see here that there are several occasions where we get such entries. So we can see that price starts to break higher here, breaks out of this range and starts to trend upward. And as we do so, the MACD line has crossed above the center line. So again, the green line in this respect is above the center line, giving us our bullish bias. And then we wait for these periods where the stochastics move down into oversold readings to give us our entry points, looking to trade a resumption to the upside. Okay. So again, it's very simple and very straightforward, but it's just about combining the two elements and really focusing on the information that they're giving. So the MACD we know is great for giving us our trend direction, and the stochastics is great for signaling momentum in the market. So where we have a bullish trend direction signaled by the MACD, we look for potentially exhausted oversold momentum to get long. And if the MACD line was below the zero line and moving lower, then we look for stochastics to register overbought readings to signal potential upside exhaustion to get short in line with the dominant downtrend. So the great thing about this method, again, is that we can scale it up to use different time frames. So you'll notice here that I'm using the 30-minute time frame, but again, you could be doing this on the 1 hour, the 4 hour, the daily, or the weekly. It doesn't matter. So depending on how you trade and what time frames you really prefer, this can be a really great method to look at, and again, is a fantastic trend trading method. So a lot of the methods that I focus on are specifically with trend strategies, as that tends to be the most profitable way to trade over time, looking to trade with the trend. And certainly for anyone approaching trading for the first time or just getting familiar with it, then really focusing on trying to get entry points to dominant trends is really how you can look to fast track your success with learning. So that's definitely something that I advocate a lot, is looking to find ways, methods that you can look to align with the dominant trends. And identifying momentum in the markets, dominant momentum, is one of the best ways you can do it. So using these indicators to help you in this respect can be a fantastic way of trading with indicators if you like trading with indicators. Okay, so are there any questions I can answer, guys? That's all of the indicator readings. That's all of the indicator examples that we're looking at. So are there any questions I can answer about any of this? Okay, great. Well, thanks a lot, everyone, for joining in. And apologies that I was a little bit late there. I had a slight software malfunction just as I was getting started, which meant that I had to reboot. So apologies for that. But we've covered a lot of material in this webinar, and I hope that you've found the topics discussed really interesting and that you're eager to get onto the charts and test out what we've discussed. And if you've enjoyed the session, then remember to tune in next Wednesday at the same time. And in the meantime, you can head to the website, www.littlefishfx.com, and you can check out the daily trade ideas that we have, the Forex reports. And if you'd like to interact with myself and the other Littlefish traders, then you can do so in the live trading room, where we're active every day, sharing charts and discussing ideas. Okay, thanks a lot, everyone. Look forward to catching you next week.